Hello, and thank you for joining today's webinar. This is the fourth and final webinar in this short series looking at the key issues that affect card issuers and acquirers. Today we are going to look at how to profit from the new technology and customer demands. Just a quick note for someone, we see someone's joined in on the conference call but isn't looking at the slides. You are able to view the slides by clicking on the link in the invite and looking over the WebEx. Anyway, so let's move on. Your presenter today is Paul Love. I'm a consultant at ACI Worldwide, with responsibility for the issuing and acquiring business within our retail payments practice. In terms of the agenda for today, I will quickly introduce ACI and our new retail solution. Then I will look at the emerging card technologies, the underlying issues and trends, and finally I will cover how banks can best respond to the new situation. This month, ACI is celebrating 35 years in the cards business. In October 1975, ACI began a long and eventful journey to become the company it has today, trusted by more than 750 customers in nearly 100 countries, and at the heart of the payment systems globally. Its solutions are used within 19 of the top 20 banks in the world. In EMEA, we have over 230 customers with offices in many of the major financial centres throughout the region, and knowledgeable staff who understand their local markets. As part of its 35-year history, ACI has had a card management solution in the EMEA for the last 15 years, which is currently in use with over 20 customers throughout the region. However, last year ACI acquired the issuer, acquirer and interchange products of Ascentis and has integrated these industry strength products to become global solutions within its overall retail payments proposition. Traditionally, ACI is well known for its strength in the network interface domain with Base24 and PRM. However, the acquirer and issuer products sit in the customer and merchant management domain. They offer solutions for managing the relationships with merchants and cardholders, their cards and accounts. Their primary focus is to support the revenue generation activities of acquirers and issuers, while the ACI interchange adds a clearing and settlement solution to the network interface domain. With these new capabilities, ACI is now able to offer a full end-to-end solution as part of an integrated retail payment solution. In today's webinar, we are focusing on one more area where these new solutions enable ACI to bring new value to card issuers and acquirers. So, let's now start with a look at the emerging technologies and what they mean to the cards business. EMV is now mature technology throughout Europe and many parts of the world. While it may still be new technology in some regions, more importantly is that it is not fully utilized in Europe and our region by many of the banks that merely issue default EMV cards that are effectively a chip card equivalent of a magnetic stripe card. This still represents a big opportunity for issuers to maximize the benefit from their investment in issuing chip cards. EMV cards allow issuers to put intelligence on the actual card, and this can add huge value to the transaction. The chip is used to authenticate both the cardholder PIN and also the merchant's POS as a valid scheme POS device, providing integrity to the transaction and the payment system. The card can also authorize the transaction offline to provide additional risk management controls or flexibility for unattended offline terminals. Importantly, the chips can be updated in the field, a feature which very few issuers use today, as they do not have the ability to send the required EMV scripts down to the card. Most importantly, chip cards cannot be skimmed or cloned and have massively reduced card presence fraud in Europe. However, while there is still a magnetic stripe on the back of a card, these cards can still be skimmed and used in non-EMV merchants. What is the future for EMV cards? Well, as we have seen, they are now proven technology, and they are certainly here to stay, for at least the next 10 years at least. There are now also some encouraging signs that the worldwide rollout will happen eventually. And even in the US, there are starting to be signs of a wavering of their not needed here stance over EMV. And now, in the last few weeks, the European Central Bank has started to push for EMV chip-only cards, much like the Visa VPay cards, to be issued by default throughout Europe from 2012. Contactless and NFC. There was a lot of excitement in the cards industry, especially at the recent ESMA conference I attended, around contactless and NFC, and their ability to grow new transaction volumes in new low-value market segments and targeting cash replacement. NFC definitely had a buzz, with people talking about over 100 projects in pilot. I personally think that using a phone as a card is an expensive way to issue cards, but it is certainly proving to be highly convenient and a compelling proposition for the customer. The key to success for banks must surely be to use the real estate on phones that cardholders have already, without bearing the cost of the phone issuing the phone itself. In the UK this week, Barclays is claiming over 1 million contactless transactions were carried out this year in the UK, and since January, they are citing a 217% rise in monthly payments. Barclaycard also claimed there are now over 42,000 contactless terminals in place today, and this is before the big merchants like the Cooperative begin to roll out contactless through their stores in earnest. For me though, NFC is a stepping stone to the future. I don't quite know what the future will be like, but I feel sure that it will go well beyond mere NFC phones. Mobile payments. This was another great talking point at ESMA. There are very many more payment opportunities for mobile phones than simply turning them into a card with the addition of an NFC antenna, as I described previously. Phones also have the benefit of a screen, a keyboard, a central processor, and a way to connect directly and securely to the internet. In short, they can provide all the infrastructure needed for a full payment service. The current key applications are mobile banking, i.e. internet banking on your mobile phone, and person-to-person payments. But I am sure we are only at the very beginning of this story, and many more applications will emerge. Only this week again, PayPal in the UK have claimed 1 million customers have now used its technology to make a payment or send money using their mobile phone. While they have been in mobile payments since 2005, they were one of the first companies to launch an iPhone app in 2008 when Apple opened its platform to developers. And as a result, PayPal's mobile customers now make an average of almost 5 M-payments a month. I read an article recently that said users do not like banking on their mobile, and they still prefer to use their computer for this reason. But I'm not sure if this is because the current crop of apps have been developed by the banks rather than the people who develop the really good iPhone apps, and we are still waiting for that killer app to be delivered. E-commerce. This is a huge market for payments, and it is also the one market where cash does not hold a dominant historical position. However, most e-commerce still relies on conventional credit or debit cards to make the payments. The main benefits of card payments in this area really come down to the convenience of having the card, the payment guarantees that this provides to the merchants, and the customer protection from fraud that this provides to the cardholder. While there has been some innovation, such as virtual cards, and verified by Visa and secure code from the cardholder side to reduce fraud, little has really changed from the use of normal credit cards in a card-not-present environment. However, there are other options available, and these are starting to grow in usage. PayPal, as we described earlier, grew from eBay, but is now much more widely used, especially by smaller merchants, and it provides a very convenient front end for using conventional credit and debit cards on the internet. Ideal, in the Netherlands, uses a different approach. From a merchant checkout, the user is directed to their own bank's internet site to send a payment via the domestic real-time credit transfer protocol, and this avoids credit card transactions at all. As real-time credit transfers spread throughout Europe, use of such low-cost solutions like Ideal will also probably grow. So let's now look at some underlying trends and issues. So card versus non-card form factor. The question here is, how do you make a card payment if there is no card involved? Several years ago, I heard Visa talk of a non-card form factor, but now, with the introduction of NFC phones and contactless stickers, this really has come to fruition. Also, e-commerce payments made with a card number rather than a physical card over the internet could also be thought of as non-card transactions. The common themes across all these non-card form factors, including mobile and e-commerce, are basically the unique identification of the cardholder and their intended payment account, a wide acceptance network for making payments, and a strong authentication of the cardholder. The current cards payments infrastructure brings such benefits as a four-party model which defines the role of the players, i.e. issuer, acquirer, merchant and cardholder, and helps them build their business models accordingly. It sets the standards which ensure the payments are accepted and get through to the right destination. And it adds security, which is vital to any payment system. However, the underlying issue for me is how do banks utilize their current card platforms to handle the growing volumes of non-card form factor payments? There are an ever-increasing number of new payment methods and networks to deal with. These include the existing international schemes, such as Visa and MasterCard, and not forgetting also the myriad of domestic schemes that are right across Europe and in other countries too. Then, there are new schemes emerging, such as EAPS and Payfair, which are positioned as the third European payment scheme. In addition, mobile networks are now emerging with strong customer penetration and high usage, as well as M-Pesa, which we've talked about earlier. The example of Mobilcom Austria is one mobile operator who set up a payments infrastructure themselves because they could not get the banks interested in providing a mobile payment service. E-commerce payments are also now part of mainstream commerce, but new players such as PayPal and Ideal are now entering the preserve of the traditional card payment market. And, as I've said in previous webinars, retailer disintermediation will see the retailer own the customer relationship and will allow them to offer new payment methods in the future. So the underlying issue for me is how to keep up with all of these new payment methods and networks and still stay relevant to your customer. The cards business is still one of the most important business segments for many banks, with a constant market growth each year in all European countries. Expectations are also growing, and consistently banks still view this segment as very attractive. The recent European Trend Survey, Bank and Future 2010, showed that 76% of banks expect to grow their cards business. As today's Guy Fawkes Day in the UK, I've illustrated this survey with a specially themed graph, which isn't working. Unfortunately, the graph isn't working on the WebEx. I can't see where the points show. But basically what this showed is that the majority of the banks want to grow both their issuing and acquiring businesses, with only a smaller number preferring to concentrate solely on issuing and acquiring. I think the percentages are something like 50% of banks are looking at both issuing and acquiring, with 25% in issuing and 20% in acquiring, with a very small number with no plans to grow. Overall, the graph shows that the growth potential still seems to be huge across Europe, but moreover, the banks still believe in the business value of cards. Okay, I can see here. I can see we have a similar problem with the graphics not displaying on the chart. Press the button? No, it's moved. It's not showing. Apologies for that. Let me try and summarize. Basically, what we're showing here is both the top issuers and acquirers have agreed the top priority for both of these is to achieve the market growth is currently to introduce new functionality like contactless chips or the issuing of EMV compliant cards. Second place is still occupied by simple expansion of cardholders and acceptance points by adding new merchants and growing the cardholder base and the transaction base. And the introduction of complete new products like prepaid cards, this was the top position in 2009, is now down in third place. Other options that scored over 10% included the expansion of the value chain by offering value-added services, adding additional brands such as Amex and also more recently JCB and China Union Pay, and finally the geographical expansion. But really this is seen as a niche strategy for large international banks that still have huge gaps in the European map. I know the next slide is not going to work, but I will quickly summarize it. Basically, this graph showed that the top innovation for this year was going to be the adoption of e-payments. This had 70% scored 70% in the survey. However, e-payments, contactless and m-payments all scored way over 50%, and there is no obvious front runner as to which was the one killer innovation that was going to be the main front runner for banks in this year. What I was going to say is that the survey results reinforce the points I made in the earlier slides, that all these new channels are key to driving new revenue streams for banks. Let's move on. So how to respond? The traditional incumbent banks are facing the challenge from legacy systems and regulation and competition, as we described in earlier webinars, have yet another challenge to add all these exciting new channels to the mix and still make money from their customers. So how should banks respond to these new technologies? To be able to profit from the new technology, banks must remove the implicit link between channel and account. Many legacy systems have the account number hard-coded into the card number, and this does not provide a flexible, future-proof platform. Banks actually need to enable the Martini effect for their payments, i.e. anytime, any place, anywhere. They should aim to accept payments from any device, any terminal, any network operator, any bank, any processor, etc., as long as they can determine that they are valid payments made by their customers and that they can manage that payment securely. Equally, they need to allow their customers to use several different payment channels to access the same account and still provide a seamless service and high-quality service to their customers. What keeps coming back to me is that essentially all this innovation is around channel, but underneath that there is still a customer who needs to make a payment, and that money will still need to be moved safely and efficiently from account to account. In previous webinars, we have looked at a unified card platform as the answer to legacy constraints and the pressure of regulation and compliance. This approach also provides part of the solution for managing the new payment technologies. By consolidating multiple payment systems into a single platform, banks will have the ability to invest in a new technology once and make it available to all its customers. For example, implementing a contactless solution once and having it immediately available both on its debit and credit cards running on the same card platform. This approach would allow banks to be much more flexible and responsive and provide a platform for future growth. Banks will be able to do more, faster, and with fewer resources. Recognizing that the customer is king, as without customers there is no cards business. In a previous webinar, I talked about growing loyal customers through offering long-term value, relationships, and differentiation. It is also important to consider how they interact with their bank, and the payment methods they use every day is a very real touch point. Part of the differentiation should be to provide a highly focused product that combines both channel and account features that actually fit in with a customer's lifestyle. That way, the bank makes the customer's life easier, and the customer keeps the card at the top of their wallet. Let us quickly look at 2 case studies of card issuers embracing new technology to build new revenue streams and make their cards indispensable to their customers. In Hong Kong, the Octopus card is a ticket to the area's mass transit system that is used by millions of people every day. On the back of this huge customer base, Octopus have since added payment services in stores around the stations, effectively becoming a prepaid card, and for many customers, it is the only card they need to carry for their day-to-day needs. In a similar vein, Barclaycard have signed an exclusive deal to add the Oyster card application used for London transport to a contactless EMV credit card. This offers similar benefit to the Octopus card, but also has the full set of standard credit card features, and again is firmly aiming at the top of wallet position. This has also driven Barclays' campaign to grow the contactless card business in the UK. So, to summarise today's webinar, in order to profit from the new technologies, banks must have a future-proof card platform that can support both the current card technology and the emerging technologies across all account types. So what are the main drivers in building a card platform for the future? As we have seen, the key requirements in today's markets are flexibility, responsiveness, and speed to market. However, there are also some core competencies that are definite must-haves in any card platform. It must be compliant with card scheme rules and regulations. It must be channel agnostic so that it can handle transactions from any channel, whether card, contactless, mobile, or e-commerce. It should be customer-centric to provide a single customer view and focus on meeting customers' requirements. And it should also be feature-rich and configurable to allow new card products to be brought to market quickly without requiring any custom development effort. However, I see the main driver to profiting from these new technologies is to build a card platform that will give you freedom. And here I mean freedom to innovate by launching new products, new channels, or to enter new markets without major core developments. Freedom to grow business, either organically, where the ability to scale is vital, or by acquisition, where the ability to migrate new portfolios to a common platform will secure the economies of scale. And finally, the freedom to stay ahead of the market, which requires all of the features we've listed above. Okay, well, thank you very much for your attention. That concludes this webinar session for today. I would hope to now like to open the session up for any questions you may have. Okay. Well, I do have some questions already, but please do try and, if you have any further ones, please type them into the box on the right and send them to the host. Thank you. Okay, so let me see here. First question I have is, will contactless be a success, and what's holding it back in the UK, seeing as though Barclaycard are investing so much in it? Well, I think contactless will be a success, but in limited areas such as cash replacement and low value. As we have seen, Barclays are now addressing what I would see the chicken and egg situation, where merchants won't invest in devices until there are cards, and issuers won't issue cards until there are lots of devices. There are now many cards and devices out there, so that issue has been taken away. I see the main sticking point at the minute is around the commercials, with many smaller and independent merchants seeing that accepting these cards are a higher cost than cash, And I think there's maybe some way to go before cash replacement via these cards is truly ubiquitous. Okay, next question. Could mobile phones really be issued and managed from a traditional card management system? I think here, I wouldn't like to say that we would try and issue mobile phones from a card platform. I think that's going too far. And there are very many people who've issued cards already. However, I do see that issuing payment applications that reside on phones is a feature for card platforms. For example, the token manager product that ACI have can actually manage mobile applications and the provisioning of these mobile applications onto mobile phones in the same way that it manages EMV cards and the in-the-field updates to mobile phones in the same way that it manages scripting to EMV cards. So there is a solution. I don't think card issuers should be in the business of issuing phones, however. I think there are plenty of other people doing that. Okay, next question. It says you talk about growth through new functionality, but what functionality? Well, actually, I think that the new functionality. This was on the graph. I think the new functionality is basically that which we talked about earlier. It was around EMV, Contactless NFC, and mobile. For people who attend lots of conferences, we heard all this before, but this actually isn't common in the field yet, and issuers are looking to actually roll this out into the field and get the growth, put the theory into practice. Okay. I think we have one final question. How much traction are Ideal getting outside of the Netherlands? Well, actually, I think at the minute the short answer is not very much. It's very specific to the Dutch market because it resides on the Dutch domestic payment scheme. However, I would say with recent introduction of faster payments in the UK and other real-time schemes across other places in Europe, the ability for a network like Ideal to grow and sit on the back of those networks is very real. So I would see that the penetration of Ideal will gather pace over time as the cost model on credit cards is disadvantageous to that on Ideal. So obviously there is a competition there. So I see the only way it can do is grow. Okay, any more questions? No, I think not. Okay, well hopefully, thank you very much. This was the final webinar in the series. I hope you found it interesting and useful. Thank you very much for attending. I'll be very grateful to hear your feedback and any other suggestions for topics you would like to be covered in future webinars. Thank you very much, and goodbye.